Okay, good afternoon, everybody. First and foremost, welcome to today's webinar, and thanks for joining us. Bit of housekeeping initially, first of all. You're all on mute, but nonetheless, we would really love to hear your questions as we go. So please, can you submit them in the chat function, and we'll be answering them at the end of each section. So, so we will be getting through your questions as we go today during the next hour. Quick introductions. So you've got myself, Matt Hodgson. I'm a partner at Claritas Tax. I specialise in M&A tax, so that's sort of disposing of businesses and acquiring them, all the tax aspects of that, and I've been doing that for 22 years. Joining me today, I've got John Davidge, who's a partner and head of corporate law at Bermans, and John Winstanley, who's business development director and chartered financial planner at Clarion Wealth. So just a quick sort of scene setting, I guess, in terms of today's seminar and the themes that we're trying to get across. The main point really is about getting one's house in order, and that, when I say house, I mean business affairs in order, well in advance of any form of exit, and really ensuring that good advice is sought very early on in any kind of exit process, and ultimately maximizing value on your exit through getting that good advice early on. So having helped business owners sell their businesses personally for the last 22 years, one of my main observations when it comes to a shareholder maximizing their value on exit and ensuring the wealth tied up in their business is fully recognized, it's really about having the right mix of advisors. And whilst the missing one from this threesome that you've got today is obviously a corporate finance advisor, who'll naturally be engaged once a decision is made to sell, the professions will ensure that your business and personal affairs are in good order, both before and after sale, are always lawyers, wealth advisors, and tax advisors. And the most important takeaway for me in my career to date is that the power of these three professions working together and not in isolation to create the best possible outcome for a business owner is tantamount. So basically ensuring that whether it's a legal, wealth, or a tax decision, one of those will always have a knock-on effect on the other. So ensuring you're working with all three, as I've said, from the outset and after exit is absolutely critical. So just moving on to what we're going to cover today. As you can see the agenda there, we've got an initial bit from me on the tax planning landscape, in particular CGT, which has been a topical tax for quite a few years now. John Winstanley is going to cover off wealth planning for business owners, turning back to myself, looking at some pre-transaction tax planning aspects for both individuals and business owners and the business itself. Then we've got John Davidge looking at the legal aspects on preparing for sale. And then it's a bit from both John Davidge and myself on disposal structures, in particular looking at employee ownership trust, which again, highly topical area. So moving on, I guess, straight away to my section, tax planning and CGT changes. So every year, although it's normally about a sort of a year out of date, the Treasury release some very interesting statistics on all taxes, but in particular CGT that we're focusing on today. So I just wanted to run through some of those facts with you briefly. Just bear with me a second. So I guess, why does it matter? Why am I going through this today? I think it's important to understand where and who pays capital gains tax and where it comes from, I would say. So covering the first bullet point off, in the 1920 tax year, which is where these statistics focus, the total CGT liability, as you can see there, was 9.9 billion, which was from only 265,000 taxpayers. And that liability was realised on 65.8 billion of gains. And as in the prior tax year, the total CGT liability and gains increased by 3%, but the number of taxpayers decreased by 6%. So there's definitely a trend there, which I'll elaborate more on at the end of this section. Probably, perhaps unsurprisingly, moving on to the third bullet there, most CGT comes from the small number of taxpayers who make the largest gains. So in 1920, 41% of CGT came from those who made gains of 5 million or more. But that group itself represents less than 1% of CGT taxpayers each year. Also, surprisingly, moving on to the next bullet point, the 265 CGT payers in 1920 represents less than 1% of the number of people who pay income tax. So you can see there that there really is a narrowing of who actually pays capital gains tax. Moving on to the next bullet, in the 1920 tax year, broadly speaking, as income and size of gains increased, the number of individual taxpayers decreased. And in that year, 43% of capital gains tax for individuals came from only 13% of CGT liable individuals with taxable incomes above 150,000. So again, it tends to be wealthier individuals who actually are paying capital gains tax. Moving on to the penultimate bullet, over a quarter, as you can see there, of CGT came from CGT disposals that qualified for entrepreneurs relief, now known as business asset disposal relief. In that year, entrepreneurs relief, as it was called then, was claimed by 46,000 taxpayers on 28.9 billion of gains, resulting in a total tax charge of 2.8 billion pounds. That's the highest amount of gains and tax since the introduction of that relief. And my observation there is that probably was stimulated by ongoing speculation of changes to capital gains rates and people looking to crystallise gains on share sales where they could. And then the final bullet, we've now got much more detailed information that's often released a year later for the 18-19 tax year. And in that year, capital gains taxpayers disposed of 1.1 million assets worth 135.5 billion and realised gains of 64.1 billion on those assets. But the interesting part of this is that financial assets, i.e. shares and investment properties, accounted for 85% of the number of that disposals. So really, it's not sort of gains and things like that. On properties, it tends to be the financial asset classes that generate gains and contribute to the exchequer in this way. So what are the trends coming out of this, and why are we seeing these trends of reducing numbers of people paying CGT, but the actual take going up? I think my thoughts on this are that there has been a relative stagnation of capital gains tax personal allowances. So that in itself doesn't certainly contribute to a huge amount of additional CGT, but nonetheless, the allowance hasn't gone up in line with inflation. So it's pushed more gains into taxation. Increase in property prices, pretty obvious point, but nonetheless, the more they go up, the higher gains are paid as and when people dispose of properties. Probably the biggest contributor has been an incredibly busy M&A market over the last 2 to 3 years. Much higher multiples being paid for businesses than I've seen historically. And then the final observation I have is the significant reduction in the entrepreneur's lifetime limit from what was the incredibly generous 10 million lifetime limit of gains taxable at 10%, which was then reduced in March 20 to only 10%. So again, capturing much more of the gain at a higher rate of 20%. So the final observation for me on the trend of capital gains tax is that it really does seem to be the case of the rich getting richer, and that may well continue to drive tax policy in this area, albeit mercifully the Chancellor did seem to reject the Office of Tax Simplification's recommendation last year to align CGT rates with income tax rates. So that was some small relief for business owners. So over to Talia. Have we had any questions come through in so far on this?
We just had the one. So it's kind of a two-part question there, Matt, where it says, what are your thoughts on the future of business assets disposal relief, and will they remove it completely in the budget in autumn?
Good question. I think that, again, there's been ongoing speculation on when they might remove what was known as entrepreneurs relief entirely from legislation. Not sure there's any listeners today who have been around as long as I have. I'm sure there are, but you may or may not remember we used to have retirement relief, which was very similar to entrepreneurs relief. I think that was a Gordon Brown initiative. We had taper relief, which was also good. Then we had entrepreneurs relief, and then that's been reduced significantly. So I think it's a good political tool, quite frankly, to stimulate entrepreneurship in the UK. For what it's worth, I don't think they'll get rid of it. I think reducing it to £1 million at the 10% rate was a politically motivated move. But there was a lot of pressure coming from various sides of the political parties to do that. So I think it will be retained. But again, this is a personal observation, and I think further stimulus will need to be given to business owners to actually stimulate them, I guess, to use that word again, to want to grow businesses and create employment, and having a more favourable tax rate for doing that, for ultimately disposing of a business, would be welcome. I also think there needs to be a longer term view on these things. So perhaps increasing that 1 million rate, back to something more like 5 million, but having to hold on to your shares for longer than the current 24-month period could also be seen. So that's what I'd say on that, Talia. Thank you. So unless there's any further questions, I'm going to hand over to John Winstanley, who's going to talk you through the important aspects of wealth planning for business owners. Over to you, John.
Thanks, Matt. So in this section of the webinar today, I'm going to just give you an overview of what I view as effective wealth planning for business owners at the pre-exit stage of a business sale, and really how that can add immense value for business owners. So next slide, please, Matt. I think the thing that I notice most when I'm dealing with business owners is that exiting their business is always a culmination of a lifetime's work. And it's absolutely vital that they get it right. In my opinion, it's crucial to engage with a quality financial planner early enough in the process. And ideally, that would be many years before they're even considering a business exit, so they can start to get their assets lined up to deal with that exit when it arrives. But I accept that for most business owners, growing the business is the priority, and that's often the thing that they focus on most in those early years. Having a financial planner in place can help to ensure that you get the maximum financial reward for your business at the point of sale. It can help ensure that tax allowances are utilised throughout your lifetime. But ultimately, it's about optimising your wealth so that when you do exit the business, when you have no source of income coming in or capital, you have a way and means of meeting your income requirements in the most tax efficient way possible, and also working towards your goals and objectives for the future. All of this can be achieved and made real via what we term at Clarion as a lifelong financial plan. And that's what I think is most important for clients, really. It's giving someone a view and helping them build a picture of how their finances will evolve over time. And typically that would be through to age 100. What we're talking about there is what money they're going to receive in during their lifetime, but also what money they're going to spend during their lifetime, and overlaying the two to give an idea of how cash flow will progress throughout their lives. This helps people understand when they can realistically stop working and exit their business. For some clients, that could be much sooner than they think. It can help to establish what their magic number is, how much they actually need from their business sale to be able to live the life that they want moving forwards. It can help clients understand the impacts of multiple exit scenarios. Perhaps a partial exit's required to meet their income requirements in the future. A full exit might be required. Some of the structures Matt and John talk about later may fit in better, and that can be evidence that it's achievable for those clients. But equally, it might be that we can help a client understand that they don't need to sell the business. They may pass it on to the next generation in some format, create some sort of capital event, but at the same time, keep the future value in the business for the next generation. But ultimately, it's about de-risking. For the majority of business owners, the business is their biggest asset. And as time progresses, we want to help them move into a more diversified wealth structure. Next slide, please, Matt. And this really is just an example of how we manage a financial plan for a client. At the top of this slide, you've got a chart which demonstrates someone's cash flow over their lifetime. And each of the bars on screen represents a year in their life and their expenditure in each of those years. That's then filled up with a colour which represents the asset class they're using to meet their income needs or their expenses in each of those years. And that's great to see it in that way. And for this client, it's a good picture. Below that is an assets chart, which shows you what's going on with the assets in the background. So for example, here they're eating away at investments in the first instance, then calling on pensions, but ultimately they retain a main residence throughout their lifetime, and that increases in value. The key to this really is trying to evidence for clients two worst case scenarios, in my view. One is that when they get to age 100, they've run out of money, or they may have done before. And if that's the case, we need to take some action now or prior to the business exit to help ensure that doesn't happen. But the second worst case scenario is they get to age 100 and they've still got £2 million in their pension or £2 million in their investment portfolio. And if that's the case, it probably means they haven't done all the things they wanted to do in their lifetime, or they could have helped their children out much earlier on in life when that value would have been more appreciated by them. So ultimately, in my view, building a financial plan for a client is about giving someone a really good understanding of how their finances will evolve and giving them a platform of data so that they can make better decisions pre-business exit, but throughout their lifetimes. Next slide, please, Matt. So when we're talking to business owners, in my view, again, one of the hardest things for them is trying to establish what's going to be important to them moving forwards. We know they're very good at running a business. We know they're very good at growing a business. We know they're very good at generating an income from that business. But the most important thing they need to do prior to sale is establish what their post-exit life will look like. For them, it's about deciding what a great life will look like when they're no longer involved with their business. I'll often ask clients what utopia looks like. So is it spending more time with their family? Unlikely most of the time. Is it traveling more? Is it embarking on a fitness program, focusing more on their health and fitness? These are all things that we want to know and we want to understand so that we can help set goals and objectives for clients moving forward. So it's key to really dial in on what you want to do when you're no longer involved with that business. Establish what matters most to you. It may, as I say, it may be having more time that you can do other things, explore other hobbies, explore other pastimes. Once you've got those goals and objectives, you can set them at that point. And I think it's always really useful to sit down and do this exercise with your spouse, perhaps even your wider household family, so that you can establish what matters to all of you most and what things you want to do for each other. That might be funding education for children in the future. It might be helping children get on the property ladder. But you focus on all of this now so that you can map out what your money needs to do for you in the run up to a business exit. At Clarion, we go do this process with what we refer to as a values and goals analysis. So we will send a client a questionnaire, which asks some very leading questions, really. We'll ask things like, if you only found out you had 24 hours to live, is there anything you wish you would have done? And that can get some quite interesting responses and help to dig out some of the more obtuse objectives that people wouldn't necessarily bring to the table otherwise. So a very useful exercise, and it helps to set those initial goals and objectives that we will focus on moving forwards. Next slide, please, Matt. So once we've got some initial goals and objectives, it's really important to refine them. And what I mean by that is talk about what those clients want to do, establish exactly what it is they want to do, then think about when they want that to happen. So put a time frame on it. Think about the cost implications. Now, some goals won't have a cost implication. I've had some clients in the past who want to learn a foreign language when they exit their business, and that might have a tutor cost, but often it's just using an app, Babbel or whatever the case may be. So limited cost there. I'm not sure how I'm going to assess those clients when they come back to see me to see if they've met their goal or objective, but we can work on that. Perhaps I'll buy a dictionary or something like that. The other thing to focus on is how it's going to make that person feel. So an example that I've used a lot with clients is they might want to help their son and daughter get on the property ladder. They might want to do that when their son and daughter get to the age of 25. They might budget £50,000 for each of them. And it's going to give them, as the parent, confidence that in early adult life, their children will be set up financially. So that's a really good refined goal in my view. Once you've got those goals, you can look to prioritize them and ensure that you know what is most important to you and then work back accordingly. And then for all of our clients at Clarion, we'll develop a timeline. And this is an example timeline on screen now where we've logged in all of the key financial events and goals that will impact this client's financial future. And it helps to map it out over time. And ultimately, it keeps both the client, the business owner, and the advisor accountable to ensure that those goals and objectives are part of the plan and are worked towards. Next slide, please, Matt. Back one. So as part of this process, goals and objectives is really important in my view, because essentially without a plan, you don't know where you're going. So for anyone that's working towards a business exit, they really need to know what life looks like post-exit and what they want to do with the capital they may receive. But before you get there, you need to establish where you are today. So it's really important to establish what we term a personal balance sheet. And as a business owner, they're always familiar with this concept. Essentially, this is about looking at what you've got now and completing a full picture of your financial affairs as they sit today. Doing that lets us identify any gaps there may be. It might be that you haven't funded pensions maximally. You might not have a pension. It might be that you haven't utilised ISA allowances. It might be that we can pull together lots of old pensions that you haven't really paid much attention to. But once we've got that picture of what your assets look like today, we can start to improve that and optimise that to work harder for you moving forwards. Alongside that, income and expenditure is a really key thing. When you're involved in the business and you own your business, it's very simple to produce an income. Once you've sold your business, that income stream will go away, and we need to understand what level of income you're going to need into the future. And the only way you can establish that is by looking at your expenditure. And it's really important to dig deep into that and assess what do you spend today, but what might you spend moving forwards. If you're no longer involved in the business, it could be that you're spending much more post-exit. And if that's the case, we need to know what those numbers could look like, what the additional holiday spend may look like, and any one-off capital expenses as well. So it might be that you plan to repay a mortgage, you want to fund children's education, you want to buy a holiday home. Getting an idea of what all of these expenses will look like and when they will occur helps to build a really robust picture of your finances, and ultimately will help give you better information to make decisions with moving forwards. Next slide, please, Matt. Pre-exit, we'll always talk to clients about effective wealth structuring as well. And the key here really is about trying to maximize the tax efficiency of what the client has today, but how they can make most use of tax allowances today to maximize tax efficiency in the future. We want to ensure that clients really have a very flexible way of meeting their income requirements when they no longer own their business. And ultimately, the aim there is to try and stop what we typically would refer to as forced income, examples of which would be dividends or salaries from a business or property rental income. We want that to be controlled so that when we look to provide an income for clients in the future, we're not forced to pay tax unnecessarily. So some key vehicles or investment types that we would look at pre-exit are ISAs, and making sure husband and wife utilise £20,000 ISA allowances each year where possible, because that will generate tax-free growth and tax-free income in the future. Utilising pensions fully to extract profit from the business tax efficiently. That can help again to grow wealth in a tax efficient manner. It can help to fund income tax efficiently in the future, and it's also a good way to shield money from inheritance tax. Unwrapped investments can be utilised, where we can use capital gains tax allowances to provide an income stream in the future, alongside utilising dividend allowances. Investment bonds are useful tools because they're non-income producing investments. We can pay an income from these investments if we want to by taking 5% tax deferred withdrawals alongside surrenders, but limited tax is paid whilst you hold the investments. VCTs can be a useful tool for business owners, allowing for additional tax relief, but also potentially producing tax-free dividend streams in the future. EIS in a similar fashion, but really about tax relief and growing money in a tax-free environment. And then obviously the business produces income via dividends or salary at present, alongside capital appreciation, hopefully, and property can provide rental income, again, utilising personal allowances. If we can make the most of all of these in the pre-exit phase and get allowances utilised and start to build up wealth in these various pots, it makes it really easy to generate a highly tax efficient income stream moving forwards. And when someone finally does exit their business, we can often give them the income they want for many, many years without creating any tax liability, which is a fantastic position to be in and places much less strain on the overall wealth. Next slide, please, Matt. Final point to talk about really, once we've looked at goals and objectives, which is really key, and getting a picture of where people sit today and how that can be improved, is risk mitigation. if you have a plan, the last thing you want is that to fall apart if the worst were to happen. So in my view, there are 4 key things you should be looking at pre-exit. The first of those is personal protection. So life insurance or critical illness insurance or something that fits into that sort of category. Because if you were to die prior to the business sale, there's likely going to be a gap in your family's financial plan. And what we want to do is bridge that gap and ensure that if you can't generate that value you were expecting from the business, it's met in another way. So that can be life insurance, critical illness insurance. It could be that these policies are provided via the business as well, which can be highly tax efficient. We're then looking at business protection. So you're working towards a business exit, a business sale. The last thing you want is a key employee to fall ill or something to happen to them, and it disrupts the business sale process. So having key person insurance in place can ensure that profit is bridged if anything were to happen to a key member of staff, and equally have shareholder protection and make sure that's in place and adequate. It protects you en route to that exit and essentially avoids any disruption before you get there. Really important to review your wills pre-exit and make sure they're fit for purpose. My experience is that a lot of business owners haven't written wills just because their time's taken elsewhere. But beyond that, the wills they often have in place aren't adequate. Business owners are complex beasts, and it's crucial that the will reflects that and takes account of all of their assets and all of their the potential efficiencies that do exist in that space. And the final point is inheritance tax. When you own your business, inheritance tax possibly won't be an issue. But post-exit, it's likely going to be a very big issue, and it's important to consider that pre-exit so you can start to put things in place to mitigate any liability that may exist. That's everything from me. Has anyone got any questions on the wealth planning aspects of a pre-exit scenario?
Someone had raised their hand, so if there was a question there, please could you just put it into the chat function. But on inheritance tax, someone has raised, is there anything I can do pre-exit to lessen the potential inheritance tax liability? You
can get a good financial planner, Talia. That's the simple answer. In all seriousness, I think there's a lot that can be done with inheritance tax pre-exit, and all 3 people that are speaking on this webinar today would have ideas about things that could be done to lessen the burden. In my view, there's a key thing for a person that's just exited their business, and it's flexibility. They've likely just come into a significant sum of money, and they need some time now to let that set in and to start to understand how things are going to move forward for them and really settle into what's going to be their new norm. So I think flexibility is key. So the easiest way to achieve that is to do something very simple, and it's to put a life insurance policy in place called a whole of life insurance policy, which will pay out a guaranteed sum to meet the inheritance tax liability on death. You can do it one of 2 ways. You can have guaranteed premiums for the rest of your life, which can be expensive but not cost prohibitive, or you can do it on a reviewable basis where for perhaps 10 years you've got a lower cost, and then that increases every 5 years thereafter in line with your age at that time. And by doing that, particularly the reviewable option, as I say, it buys you some time. It lets you know that if something were to happen to you, that new inheritance tax liability is going to be met and your estate beneficiaries are going to get the whole value of your estate. But it doesn't tie you in knots by putting structures in place which perhaps aren't suitable for you when you're not quite certain how your finances are going to play out. And I think, again, that's something that financial planning and lifelong financial planning can really assist with, because we can help to evidence perhaps what money you may not need to use in the future, and that can help to ensure that the structures you put in place are appropriate. So simple answer, life insurance for simplicity and flexibility.
That's great, John. So unless there's any further questions, I'll just quickly move on to the next section. So I'm a business owner. I'm 18 to 24 months out from a potential exit. What should I be thinking about from a tax perspective, be it for myself personally or from a company perspective? So some pretty straightforward stuff on this slide, but nonetheless, things that we actually see time and time again either get forgotten about, missed, or we need to remind clients about, but usually it's with about 6 weeks to go prior to signing on the dotted line. So just focusing on individuals, first of all, yeah, definitely a simple one. John mentioned it, but top up your pension if you can. The annual limit's 40k, assuming the individual's taken no benefits. and any unused allowance can be carried forward for 3 years. So every April, you potentially lose a year's brought forward allowance. And you can only pay up to the value of your relevant earnings in any given year, even if your allowances are greater than your earnings. So if that's likely, then you can also look at making potentially a company contribution to the pension as well. But beware that the limit is reduced now for high earners. So we're looking over 200 to 240k. So just be aware of that as well. Spousal transfers, something that often gets looked at the absolute death, where you've got wife transferring to husband or vice versa on sale to try and utilise more of one another's business asset disposal relief allowance. Not so easy anymore. You need a 24-month run-in to be able to do that, unless the transferee already has a 5% stake in the business. And then you could potentially top that spouse up with more shares shortly before sale. But really, getting 5% in of your shares into your spouse's hands now is a good idea if you've got a minimum 24-month run into sale. And then the final point, it's actually a point with an awful lot more behind it, but a lot of planning that we do involves, particularly, as I say, 18, 24 months out, is looking at transferring some shares now, be it into trust, be it into a family investment company or some other form of structure, to actually route some of the gain into a different tax environment on sale, as opposed to all those funds coming to the individual personally. And as John mentioned previously, having an immediate 40% inheritance tax issue as soon as you get that cash. Moving on to the business aspects, we are doing more and more what I'd call sort of mini pieces of vendor due diligence, which tend to be, as I say, about 2 years prior to an exit. And we're doing that because it's, in terms of actually maximising value, what we tend to find are price chip items. And if we're finding those early, they can be rectified. We can be in touch with HMRC. We can be getting legal paperwork updated to amend things. We cannot do that just before a transaction. So really that first bullet, getting your house in order, is that point. Good tax compliance across all areas. By that, I mean payroll, corporation tax, VAT, CJRS payments, which we're seeing an awful lot of focus on now from HMRC. Share scheme filings, the requirement to actually file now with HMRC in July, following any sort of share issues to shareholders, option holders. They get missed all the time. So yeah, again, just ensuring all that is ticked. R&D claims, a massive focus of HMRC now, and I think going forward, I think the scope of being able to claim for R&D will be reduced massively. But again, we see some quite sloppy claims that have gone in, which again will get picked up in DD, and then more than likely potentially see indemnities in relation to those. Looking at all the shareholder transactions, i.e. share transfers, shareholders exiting previously, new share options being issued, so on and so forth. That always seems to cause complications, particularly around the values that are paid for shares, and that there's no potential hidden income tax exposure on those shares as well. And the final point really is more about upside and opportunity, making sure that all tax reliefs, whatever they may be in the company, have been utilised and maximised as far as possible, but as I say there, within reason. So really that was just a quick rattle through of what could be done prior to a transaction to ensure that the shareholder maximises the value. So back to you, Talia. Any questions at this point?
Yeah, there has come. I've heard quite a bit about family investment companies, but don't really understand the tax benefits. In a nutshell, could you explain what these are?
Okay, that's I'll try with a nutshell approach then. So essentially, nothing more. Family investment company is nothing more than a limited company. You can either implement one pre-exit or post. If it's pre, it needs to be a minimum 25% of shares transferred into that company first and foremost. It will be held, typically majority held by the founder shareholder, whoever it is that's transferring the shares, and family members, as in the title, will also be included in the share the shareholder structure of that company. And the rationale for doing that is often about value, so an inheritance tax. So there are specific rights that will be granted over the family shares, potentially wife or husband, whoever, and also children, such that they essentially get value accruing to them over time on their shares. So essentially value going out of the vendor's inheritance tax estate and into their estate over time. The post-exit route, quite simply, is, let's say I've got £1 million of cash, I loan that into a new company that I establish along with my family, and then that company invests via John at Clarion Wealth, or it invests in property, or a combination of everything. That balance sheet on day one is zero, because you've got £1 million of assets and £1 million of debt. Over time, the debt is repaid, thereby increasing the value of that balance sheet, along with the asset classes increasing in value. And again, slowly but surely, value is passed over to the family members. So that is it in a nutshell, Sally. Okay, so unless there's any other questions at that point, we're over to John Davidge, looking at the legal aspects, preparing for sale. So I'm a business owner looking to sell my business to a third party, John, looking to trigger a potential capital gains tax charge. What should I be thinking of?
Thanks for that, Matt. Well, basically, Matt touched on it before in his presentation. It's really all about preparation and anticipating potential issues through the buyer's due diligence. So that's the way we approach it. But I guess the sort of starting point is it's good corporate governance, which should really be done throughout the life cycle of the company, but in particular through exit. So any of the things I touch on today, usually as a growing SME corporate, you should be reviewing these things on a regular basis. But I think there's some good tips in here and some good building blocks, which essentially what they'll do is they'll save you a lot of management time and a lot of legal and tax costs in the future. Because if for instance, a large PLC or a private equity house is buying your businesses, and there's a whole load of issues that are unearthed in due diligence in relation to the share structure, the contracts, etc., it will cause hassle in the process. It will cause costs and frustration. So these are just some areas which can help. So the primary one, really, and this is missed sometimes, is the share structure. And the reason, I guess, there is because in the UK, there isn't any central register for shareholdings. There's notifications on Companies House, but it's actually left up to the private limited company to get its house in order and to have a private set of ledgers for those shares. So it's really, really important when you're going through any investment phase or any sale is to go through forensically your share ledger and to make sure that absolutely ties up with Companies House, because if it doesn't and shares haven't been transferred correctly, or the prime example here is if there's been a share buyback in the past that had been done incorrectly, that can cause all sorts of problems with ownerships of shares. I'm sure some of the accountants on this seminar will understand that, the issues with void share transactions. So that's really important. Other examples that are missed are A, B, C, and D shares. They're referenced on Companies House, but those rights need to be in the Articles of Association to give separate dividends, separate rights to shares. So those are some easy wins in there as well. The second sort of area that's really, really important is locking in your human capital. That's really important for going, whether it's a trade sale or a management buyout. You need to make sure that not only the sellers are locked in, as they will be, but your succession route there. And Matt touched on this before, and the best way to deal with this is through share options, either by a gross share or an ENI option scheme. They're a very good way to take the team on the journey until exit. And we all know the pressure at the moment with salaries and bonuses, etc. They're just going up and up and up. So a really good way to differentiate yourself is to have share options that have a true meaning. Now, the mistake that I've seen in that area of people granting share options is they don't communicate the exit plan to the staff. So that's really important as well. You have to have a true exit plan, whether that's 3 or 5 years, but you need to communicate to the staff, because I've seen some in the past that, they're there 7 years after the issue of the share option, and there's no exit, and that can cause issues in the ranks. So that's a couple of things there. The next stage, which is obvious but should be reviewed on a regular basis, is the shareholders agreement and your articles of association. Many examples I've seen here is shareholders agreements aren't reviewed after a founder or a shareholder have left, so they need to be updated and reviewed. But the most important thing really to concentrate on in your articles and your shareholders agreement, moving towards an exit, whether that's over a 1 to 3 year period, is what you call your leaver provisions. And you'll potentially know the concept of good and bad leaver, which essentially means that, you know, if an owner manager leaves, the shares can be purchased back by the company, which is essential because equity needs to follow the value add by management. The last thing that any owner manager wants preparing for exit is to, you know, one of the senior team to leave that may have 10 or 15% of the equity, and the leaver provisions don't allow those shares to be purchased back. It can be quite catastrophic. So there's a lot of text in articles of association. They're quite complicated, along with shareholders agreements, but that for me is the absolute main focus, is your leaver provisions. You need to make sure they're absolutely tied down, and it's something that we litigate on and we help on a regular basis, but something that's very simple if you review it on a regular basis. And of course, the restrictive covenant, which will be in the shareholders agreement, needs to be reviewed because that's the most robust covenant as opposed to the employment contract. So that's to basically lock in the equity. And then you're moving down the corporate structure into the more commercial aspects of the business. So the easy wins, you know, if you're an IP, intellectual property weighted business, is to make sure all that intellectual property is absolutely vested in the company. Now, when a startup starts and grows very quickly, often they'll have consultants that design their software, or they may have all different methods of designing that IP. They may have been a spin out from a university. You have to make absolutely sure that that intellectual property is assigned within the business. And like Matt said on his vendor due diligence, you don't want to be doing that 6 weeks before completion. These things can take time. So a number of my clients, if we have a standard IP audit where it's got a raft of questions that we can send them over, and then we just make sure that that IP is invested into the company. It may be having to ask people that have left, or having to ask current providers to sign IP confirmations, but it's usually not a problem. And if it's caught early, again, it's all about anticipating these issues that can cause problems in the future, and sometimes price chips and difficult conversations throughout the sale process. You prepare early and look at this now, it will save you time and money. And then moving down the list, terms of supply condition to customers and suppliers, they should be reviewed on a regular basis. Employment contracts for the second tier management team, make sure that you've got restrictive covenants are very clear, your notice periods, that the manager's roles are very clear. Look at your lease, make sure that the lease terms are what you thought they were, that there's not going to be any surprises about repairing covenants. I've seen many leases where people thought they weren't responsible for repairing parts of the roof. It comes to due diligence, there's an almighty shock. So these things need to be looked at, and dilapidation is also key if it's a manufacturing and industrial site. These discussions can be had subtly with landlords, during a preparing for sale phase. Regulatory, also the concept of change of control. For instance, as John will know, the FCA regulates numerous businesses. That needs to be looked at an earlier stage. The FCA is taking, considerable time giving consent to change of controls at the moment. So you need to make sure the regulatory side of the business is in order. There's things throughout the pandemic have took longer and longer from a public body perspective. You need to look at that. Again, FCA is a big one. Environmental is a big one at the moment. Make sure all your environmentally and regulatory consents are absolutely bolted down. So those are just a few tips that you should really look on a yearly basis anyway for good corporate governance. But if that's all bolted down, you'll find that the due diligence process can be simpler. So once all that's boxed off, what another time saving and a really good way of preparing for sale is vendor due diligence, and Matt is doing more and more this on the tax side. But you can also do this on the financial side and the legal side. So, you know, what we can do there is we can set up a data room, issue a standard legal questionnaire, and in effect, you can do a dummy run and prepare what you call a seller pack for the buyer. Now, you see this a lot in private equity transactions, what they call auction sales, whereby the seller is responsible for preparing the data room and putting all the legal documentation in. But it means that, you know, once the heads of terms are signed on any deal, then you're not running around trying to populate the data room, taking your eye off the ball from a management perspective, because that, what you've got to bear in mind as well, the sale process takes a lot of management time. And when you're having to run the business and deliver the figures throughout the process, that's the last thing you really want to be doing. So preparing for sale, not only is the key stages we've mentioned about share structure, human capital, but I do strongly suggest that tax due diligence, financial due diligence, and legal vendor due diligence is worth considering on the larger sales, because it will save you a lot of time and hassle. We offer this service to clients as well. So, you know, if any of the people on the seminar need to talk about that, on how we can deal with that, we can talk about that offline. So that's, there's many more ways of preparing for sale, but those, for me, in my experience, are the easy wins and a good processes to put into any business anyway. So I think that's the first section. Talia, have we got any questions on that section?
There are two questions actually.
Yeah.
So the first one being, if a PTE limited company issues shares in ABC later on, does the articles need to be amended, or can one just add a paragraph at the end of the article of association? And does the new paragraph need to be sent to co-house or the whole articles of association?
A PTE company, is that an Australian, a UK company? Sorry, I didn't get the first part of the question.
It says if a PTE limited company.
Oh, private limited company. I mean, yes. You do technically need to refile the articles on Companies House. Companies House will sometimes kick it back, sometimes they won't, but technically under law, what you need to do, if there's any amendments to the articles, it needs to be enshrined in a new set and passed by a written resolution by all the shareholders. Yeah, so you do need to refile the whole document.
Lovely. And then there's another one that's popped up as well. There's one that says, what is the typical timeline when starting to prepare for an exit?
I mean, I see them sometimes. You'll get heads of terms at London. They'll say we have to complete in 2 weeks, but generally when you've got a decent team of advisors and the owner manager says, look, I want to go now, you know, it's between 6 to 2 years. But again, my view is once you've gone through the growth stage and then what's the next step in a business? Well, it's got to be an exit. So naturally, you should really be preparing for an exit throughout the life cycle of the business. That's my advice, because what that does then, it puts a framework in place, which means those preparations are much easier when you come to the exit, rather than trying to scramble and do everything all at once. Put the corporate governance structures in place, and then it makes everything a lot easier as you actually go to full crystallization.
Lovely. And then a final question that I could see, it says, if a company is sold with a lease and something untoward arises after sale, could there be a comeback on the seller?
Yes and no. It will all depend what you have put in the share purchase agreement in respect of the warranties about the lease. So you'll obviously have a lease that the company is your party to, but it will depend on what you've actually warranted. So a simple example, you'd always warrant that you've paid the rent. If you've not paid the rent, there is potentially a claim. But the most issues you see around leases is really on the dilapidation section. because they haven't agreed a reasonable dilapidations amount with the landlord. And that's really up to your lawyers, surveyors to make sure that there's an apportionment. So say if you've got a lease that's 10 years old and you're selling the business on 5 years, you should get a schedule of condition done on 5 years. And then there's an apportionment put to that when the dilapidations claim is done at the end of 7 years at the break. But usually, you know, you have to make sure, check the warranties in the share purchase agreement, make sure you do full disclosures. But generally, dilapidations are the main issues you see in a lease.
That's all the
Does
questions.
that answer the question? I'm not sure it does.
We're moving on, John. Just a quick time check. We've got 10 minutes.
Right, fine. I'll fire off. Right. So disposal structures. So there is numerous disposal structures we can discuss. There's listings. There's various structures, but these are the main headings. So, and again, the key to discharging these structures is preparation, which we've touched on. The first one is a trade sale. So that's usually 100% to a trade buyer, usually a strategic purchase within the sector. I've seen a lot of these over the pandemic where the US entities are coming into the European market. So what they tend to do is they'll pay, the advantages of that is the US buyers usually have a lot of money. They usually pay a lot of the consideration up front. And there isn't a high expectation on the sellers staying on for a long period. But they will rely on the incumbent management. So again, this ties into having a really strong second-tier management team, which is what I say to any owner-managed business. Make sure that business runs without you, and that you can go on holiday or not be there, but you've got a strong team below you. And again, those options again aren't always available. Trade purchases. So the second style of purchase is the management buyout. So there's a plethora of these, but we'll focus on two. So the first one I'll focus on is the vendor assisted management buyout. So this is in effect the founders of the business selling their equity to a new company which is owned substantially by the second tier management team. Now that tends to be the consideration, the sale price is funded by the vendor. So the vendor stays in, has what you call deferred consideration over a number of years to allow the management team to pay off the debt. This is very popular with retirement sales. It's very popular with, I've seen quite a few in architects, businesses, accountants, areas where trade sales are less prevalent. Because it allows the old founders who trust their employees to, in effect, pay them off the value of the business by provide deferred consideration. And any management buyout, I'd always advise that you ask the management team to invest some of their own wealth. They call it skin in the game. You can raise debt finance in a vendor-assisted MBO. Can be, relatively low, and it'll rank alongside the vendor's finance as well. The warranties in those agreements, i.e. the statements given by the sellers about the strength of the company, are very limited because it tends to be that the management team is already aware of the business. So that's quite a streamlined transaction. Some professionals and architect businesses I've seen have used those and they've worked well. The second MBO is the bank and private equity backed management buyout. Now this is a more complicated structure whereby there's probably less risk for the vendor because there's more institutional money being invested. It's more complex structure and it's DD heavy, and there will be more intricate protection for the PE house post deal. So can be a quite complex and more structured process, but there's probably more protection for the vendor in that circumstance. Sorry, Matt, I'm just trying to move on as quickly as possible here. Yeah, so that's a couple of examples there. We could have an entire seminar on those, but I think we're short for time. So the next one is EOTs, employee ownership trusts, which are extremely buoyant in the market at the moment, increasingly more and more. And that's sort of a structured chart which looks quite complicated, but actually it isn't. overly complicated. They were introduced in 2014 to assist with individuals passing individual ownership over to the employees for diversification of ownership of companies. It represents a way of passing over to the next generation with or without bringing in outside partners. Very attractive tax advantages, which Matt can just touch on now.
Thanks, John. Yeah, so, certainly from the vendor's point of view, very attractive because there is complete relief from capital gains tax, which is a pretty much rare thing these days for the vendor. Assuming that there are no sort of events that can disqualify it, which I'll come on to in a second. It's not without risk still though. There's got to be that second bullet point, essentially saying that there's still got to be a main. There still mustn't be a main purpose or one of the main purposes of being a non-commercial motive, i.e., you've got to be doing it for genuine reasons. The sale of the business to the employees via an EOT. And yeah, third bullet, transfer shares. Basically, what we're saying there is that the transfer of the shares into an EOT would not trigger any inheritance tax on that transfer. So again, bonus for the seller. From an employee's point of view, it's pretty good. You become essentially a beneficiary of the trust and a quasi shareholder of sorts in the business. You can get tax-free bonuses up to £3,600 a year, but that doesn't exclude what we say there is 5% participators. What that is they can't be beneficiaries in the trust, i.e., benefit from potential upside in the future if the business is ever sold or they receive proceeds from the trust on that sale. And the final point from the company side. The company is unlikely to receive any corporation tax relief from any fees associated with setting up the EOT. So those are the key tax provisions, and then the actual conditionality. There's quite a lot. Very, very quick rattle through because we've only got a few minutes to go. So it must be a trading company, obvious point. It must be at least a 51% or greater disposal into the EOT by the vendor. The EOT, once it owns the company or has that controlling stake, cannot lose control without consent, and there are various clawback provisions in place based around control. Essentially, in the next couple of years after exit, that can claw back the capital gains tax that potentially should have been paid. The EOT can't make loans to the beneficiaries, i.e. the employees of the business. There's a bit of a strange fraction that the revenue lovelies around who can or cannot hold shares in the company afterwards alongside the EOT and how much in terms of quantum that they can hold. EMI is a really interesting one. You can have EMI share options in the shares alongside an EOT, but this is sort of hot off the press, is that the valuations team at HMRC are starting to reject any debt that has been introduced to the business in relation to, for instance, normally you've got a large deferred element outstanding owed to the vendor, and they're basically starting to say that you cannot use that in the valuation calculation when quantifying what EMI options are worth. So that's, as I say, quite hot off the press. And I think we've covered disqualifying events really, so I won't go into any great detail on those. So back to you, John.
Yeah, so thanks for that, Matt. So the tax advantages are really important, but some business owners will love the idea of an EOT and some won't be as keen. Suggested the following question is asked by yourself, and the reaction of it can be judged. So assuming the company is worth 10 million today, how would the owner manager feel in 5 years' time if it was sold to a main competitor for 25 million, and not only a percentage of the uplift was shared by that owner? Because most of the time in employee ownership trusts, the current owners stay on, and they are still allowed to drive the value of the business. So conceptually, you've got to get over that hurdle of not being completely in control of the equity. Now, if the reaction to that is that's fine, it's altruistic, I want, I'm fine with sharing the increase with the employees as a whole, then EOTs are for you. So if you can get over that hurdle, EOTs are deceptively easy to set up. The consideration, the sale price for the shares can be genuinely altruistic. It can be a gift. It can be left on deferred terms. Now, the vendor loan, the security on that must not be against any shares in the company. It must be against the assets, not the shares. You can fund an EOT by the bank. Various of the retail banks fund EOTs at the moment. So as stated, the sellers can stay on the board and they can continue to drive value. Using a valuation rule of thumb, 8 to 10 times EBIT to give the company a valuation. Then assuming the profits are static, the sale of the shares in an EOT can mean potentially founders can extract 9 to 12 times their target distributable profits on a tax-free basis. So the tax saving element of it, and the if you've got confidence in your employees stroke management team, it is a very attractive model to owner managers, and this is why we're seeing more and more, and particularly professional services, sales orientated businesses whereby salaries go up, bonuses go up. If the employees can be tied in this way, it is attractive. So the summary of the legal process quickly. They establish the employee ownership trust. It's usually through a company limited by guarantee. So this is usually individuals that guarantee the liability of the company up to £1. Then there's individuals appointed to the board. The trustees and directors can be the founders of the selling company, but tend not to be if there isn't a deferred consideration. The EOT, the employee benefit trust, is governed by a trustee. That regulates how the shares are dealt with, how the dividends are paid, how the beneficiaries are remunerated. The EOT is always encouraged to engage employees to get employee representation. So you can have an employee council that can restrict certain ways how the EOT distributes any benefit that it has. That's in more cases than not that is used. You have election for the employee council. And you have a clear number of people that are engaged in the process. The documentation required for this EOT to acquire the target business, very similar to a traditional share sale. So you've got a sale and purchase agreement. You've got the terms of the EOT that needs to conform with any security given by the vendors. The most likely divergence in the sale and purchase documentation is the extent of warranties given by the seller to the EOT. These tend to be less than is usual. Disclosure letter, again, it's the same. And then articles of association need to be amended to make sure they fit with the constitution of the EOT. And if 100% of the company isn't sold to the EOT, you'll have a shareholders agreement, which follows the same vein of what we've discussed previously. So, Matt, that summarises everything I have to say. I don't know if anyone's got any further questions on my section.
It was just the one, very quick one. On valuations of a company and sale price, what does on a debt-free / cash-free basis mean in practice?
I mean, Matt can jump in if he thinks I'm getting this wrong, but simplistically, when you're valuing a company, you'll do it on a multiple of profits. So for prime example, if your EBIT is 1 million and the market dictates it's a 5 times multiple, your enterprise value will be 5 million. And then you have a thing called the equity bridge. So to bridge to your equity value, you have a concept called free cash in the business. So it's essentially the cash in your bank account less institutional debt and corporation tax. So that's your net cash. And then that gives you your equity value, which is subject to another slight increase called a working capital target. But I think the detail on that could be, again, another seminar in itself. But essentially, it's your free cash plus your enterprise value.
Pretty much spot on, John. Right, good stuff. So
yeah,
we're a few minutes over, so thanks to everybody who's still on. Really appreciate your time. I hope you all got something out of that. That is us about done. moving on to the final slide, it really just leaves me to say a big thank you to the speakers today. So thanks to the two Johns, and also thanks to myself and for everybody who's attended today. You can see from this final slide, we'll be running part 2 of this seminar in a month or so's time, Tuesday, the 10th of May, where we'll be looking at once a business owner is exited, how do they actually best protect their money going forward, what structures can be used, how can it be appropriately invested, so on and so forth. So there's a lot more to come, and we look forward to seeing you in a month or so's time. Thank you very much.